Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at MRVL, or Marvell Technology Inc. MRVL is a fabless designer, developer, and marketer of analog, mixed signal, and digital signal processing integrated circuits. That was a mouthful. Here's the barchart.com technical opinion rating for MRVL. The bar chart rating is a 96% buy, with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that MRVL is well above the moving average line, so the monthly trend in MRVL is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since at least September, so the daily trend in MRVL is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. MRVL is below the upper Keltner channel line, so MRVL is inside the buy zone. Since the trend is up, we want to buy a call. MRVL has plenty of options chains to choose from. We're going to use the January 17 chain. Right now, the Jan 17 options have 25 days to expiration. Here's a good chunk of the MRV option chain for Jan 17. MRVL closed at 111.90 on Friday. That means any calls on the list from where 82.5 to 110 are in the money. Let's take a look at the profit potential for purchasing the 110 strike call, which is the closest active strike to the current price of the stock. The bid-ask spread for the 110 call is 655 to 9 even. We try to enter at the midpoint, so we use 780 as the buy price. Our call option calculator shows the profit potential for this call based on MRVL price changes at option expiration from flat to a 12.5% increase in price. We can see that if the MRVL stock price is flat at 111.90 at option expiration, the 110 call will lose 75.6% of its value. Ouch, this is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 95 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 95 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the MRVL stock price is up 1%, the 95 call will lose 3.1% of its value. We want that to be break even or better, so the 95 call does not meet our requirements. Let's see if the 82.5 call will work. The bid-ask spread for the 82.5 call is 28.80 to 31 even. We tried to enter at the bid point, so we'll use 29.90 as the buy price. The 82.5 call works. If the MRVL stock price is up 1%, the 82.5 call will make a 2.1% or $62 profit. That's better than break even, so the 82.5 call is the one we'll buy. The call option purchase calculator also shows that if the MRVL stock price increases by 2.5%, the 82.5 call will make 7.7% or $230. If the MRVL stock price increases by 5%, the 82.5 call will make a 17% or $510 profit. If the MRVL stock price increases by 7.5%, the 82.5 call will make a 26.4% or $789 profit. The plus 10% and plus 12.5% percent numbers are also displayed, you can see that the profits get better and better. And notice that if the MRVL stock price does not make the expected move up and remains flat at expiration, the 82.5 call would only lose minus 1.7% or minus $50 compared to the minus 93.9% or minus $780 for the 110 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the MRVL Jan 17 97.5 strike call and sell to open the Jan 17 105 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 97.5 call for 15 even and sell the 105 call for 10.75. 15 even minus 10.75, equals 4.25. So the entry price or debit cost for the spread is $425. The call option spread analysis calculator picture shows that the spread will make a 76.5% or $325 profit if the MRVL stock price declines by 5%, remains flat, or increases in price when the options expire. If MRVL is down 7.5% at expiration, the trade will make 41.4% or $176. Creating the debit spread will allow us to collect a $1,075 cash credit to our brokerage account for the sale of the 105 call. As we said on the previous slide, this reduces the cost of entering the spread to $425. Here's a note regarding earnings reports. The next MRVL earnings report is scheduled for March 4th. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the MRVL Jan 17 82.5 strike call for $29.90. We also reviewed the spread. The spread said to buy to open the MRVL Jan 17 97.5 strike call and sell to open the Jan 17 105 strike call at a debit of $4.25. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.